dive straight into the corporate conversations that we've got lined up for you. We've got Mr. Ravi Jakar, the Director of Strategy and Group CFO at Allcargo Group, and very interesting to speak to this company right now in terms of their outlook as well as the outlook on the sector with everything that's happening on the geopolitical front. Opportune time to be speaking with you. So thank you so much for your time today, Mr. Jakar, and good to be speaking with you. Let's start by talking about the company and your outlook going ahead. You've guided EBITDA to profit before tax to grow ahead of revenue in FY27. If you don't mind, can you put a number on the margin target you're working towards?
So, Snehi, pleasure to be on your show. If I can just put in context, we're talking about a group structure here which has been going through a massive reorganization over the last 4 years, which has now come to a conclusion with the listing of Allcargo Global, which is our flagship international supply chain business. So it got listed about 10 days ago. So now we have 4 companies, each one focusing on a specific business, and that provides a lot of clarity to investors and also brings in sharper management focus. So that's something which is the most important milestone for the group, which got concluded about 10 days ago. Now, on the main flagship business, Allcargo Global, we had been witnessing extremely strong headwinds in terms of the geopolitical environments, tariff barriers, trade environment being very tough, I would say over the last 12 to 18 months. We feel that we have seen the bottom towards the close of the last calendar year. And since then, we have seen marginal improvement in terms of the business momentum. And going forward, of course, it depends on how the geopolitical environment continues to evolve. But we believe that from here, there should be a gradual recovery in the overall global operating environment as far as trade is concerned. But what is important to note from the company's standpoint, and that's where I'm coming to your point on margins, for the last financial year, our revenues dropped from about 14,000 crores, roughly about 10% from those levels. But we were still able to bring in, sharper focus on operational mix, the trade lanes, the right kind of, container utilization, and a lot of other initiatives, because of which we were able to increase the gross profit despite a dip in revenue. And it was a healthy more than 2,750 crores of gross profit. And the biggest cost for us in this business has been the SG&A costs. And the developments that we have seen over the last 12 months in technology really opened up new opportunities for us, because things which were slightly complex and required human involvement, and given an international business, that's a big part of our cost. We are now able to find opportunities to downsize the cost of operating for every cubic meter of cargo that we handle, which means that we can continue to grow at a more tighter operational control, which means that the margins should expand. So that's something which, sequentially we are witnessing. Of course, a stronger business environment would add tailwinds to that. But at this point in time, we believe that that's the trend which should continue with some momentum on margins expanding. And there were a lot of one-off, reorganizations last year as well. So I think next 4 weeks, we should be publishing the quarterly numbers for the global business. And that should give a good sense of where we stand on the global business and how it looks like going forward. On the domestic side of the business, again, the story is quite similar. We saw a growth in revenue as well as a very robust growth in EBITDA. EBITDA for the year grew by almost 14% last year. But more interestingly, for the last quarter, it was 40% year-on-year growth. And that's, again, a story of the turnaround in the domestic express business, being done. And from there on, the business environment in India has anyways been strong. The domestic consumption-led logistics growth has remained strong for last, I would say, at least 4 to 5 quarters, and the momentum remains similar. So we expect that in the domestic business, which is operated in all cargo logistics, we should also continue to see, a flatter cost base with rising revenue, and that means that we can possibly see the margin expansion. I would refrain from putting specific guidance to that, but we have provided 3-year guidance across all the 3 businesses, these 2 as well as our ICD CFS business, which is under All Cargo Terminals. And we believe that the businesses are more or less aligned to those targets
Okay.
as we move forward.
Okay, understood. So now that the integration is already done, we're going to start seeing the benefits and some steadiness in the quarters to come. But Mr. Thakur also talked to us about how are the freight volumes shaping up? What would your outlook be on global freight volumes, given the disruptions that we're once again seeing on the West Asia front? There is so much back and forth in terms of the opening and closure of the Strait of Hormuz. How are you reading through, and how would you plan to navigate through the turmoil that we're seeing in the sector?
So there has clearly been a disruption, and that continues to remain that way as far as the Middle East is concerned. But there's also been a stronger momentum on, let's say, Asia to Latin America trade. There's also been some degree of renewed momentum on the trans Pacific and both transatlantic trade as well. So what we are witnessing is that on one hand, there remains a volume shortfall on the Middle East trade, but we also see volumes picking up on the other trade routes. And therefore, at a global level, we feel that at least on a quarter-on-quarter basis, if you look at the last 6 months since the war, there has been slightly positive momentum, and that's also reflecting in the higher freight rates that we see across a lot of trade lanes. I believe that these freight rates should possibly stabilize over the next 4 to 5 weeks, and then be around those levels. We don't see these continuing to spike up, but like I said, in summary, there's a issue in the Middle East, but on the global basis, overall, there's a slight positive momentum on the volume side, and even more on the freight rates.
Okay, that's interesting to know. And Mr. Chakar, if you can help us understand how has the PM Gati Shakti initiative and dedicated freight corridors changed logistics efficiency in India? Just give us a broad sense of that as well.
So I think dedicated freight corridors bring in more efficient rail transit into play. We had been waiting for the Delhi Mumbai freight corridor to be fully completed, which is now near completion with some of the last leg of the connectivity to JNPT also coming into play. At Allcargo, we are in fact building up a very meaningful infrastructure in NCR in the Allcargo terminals business, which is our inland container depot at Farooqnagar, which connects to the dedicated freight corridor. And we believe that it'll improve the transit time. And of course, I don't see the near-term impact of the other freight corridors which have been announced. But once we have multiple other freight corridors also completed, we should see faster transit of cargo, lower cost of handling as well. And I think that's something which should be one of the enablers for the Indian economic growth. On the PM Gati Shakti terminal as well, we are seeing a lot of investments coming in from the government as well, in terms of enabling private sector to be able to set up these terminals by providing the requisite land, connectivity, and the basic infrastructure with multiple multimodal logistics parks being put up for auction. We have also seen various freight terminals being also put up to tendering as well. So I feel that over the next 5 to 7 years, we should see more and more such terminals coming up. We should provide for better multimodal connectivity, and it would provide the much needed movement for the trade, because for the economy to grow, the trade has to be very efficient and smooth. And the combination of freight corridors on one hand and much improved road infrastructure on the other means that India can continue to grow at a high single digit as far as the domestic economy is concerned. So I think they play a very important role on the economic growth.
Right. Thanks for putting that down so wonderfully for us. Mr. Chakar, the other concern is on the pricing front. We've seen freight rates gone up. We've also seen Brent now that has once again spiked. So you've got crude prices also that are now on the upside. Talk to us about how you're looking at pricing for your company as well as for the industry. What is going to be the rate of the pricing pass through, and when would that happen in your view?
Yeah. So as far as the international shipping is concerned, we have seen that while there is an impact of bunker costs, we have generally seen over the last, if you look at a longer 10-year window, the greater impact on freight rates comes from the demand supply dynamics more than the crude pricing. So there, the impact of crude per se is limited. It's more of the temporary demand supply situation. On the domestic front, naturally, fuel costs are a large part of our operating costs. But I think on that front, again, the government has been very supportive to the businesses by ensuring that the increase in fuel costs has been limited. So I believe that, the overall environment is moving more towards peace, even though, of course, there are, daily ups and downs in terms of the news on the war. But I personally believe that we are moving towards stably lower crude price levels. And with the government's outlook of not passing on the entire cost, which is what at least it seems to be now, I think the impact can be controlled. But there is certainly a slight impact on the domestic logistics cost for us on the fuel cost rise. So we really hope that the war comes to an end, and then we are not under any pressure. And the government also is not under any pressure to subsidize those costs.
Okay, so that we're going to be making a note of that on the pricing front. Mr. Thakur, lastly, with warehouse capacity expansion now going asset light via operating leases, how does that change your own capex guidance and return ratios for FY27? Any incremental change in that guidance?
So on the Allcargo logistics business, where we operate the warehouses and contract logistics business, we do not have any material capex requirements. All the warehouses are on operating lease. Even our truck fleet is entirely from our vendor partners. So while we run and operate the network and we run and operate our warehouses, we do not make any capex towards that, barring some equipment here or there. So overall, the business will continue to be extremely asset light, with investments being a very small part of the cash flow generated. So I would say almost a near minimal capex for the Allcargo logistics business, and the same story is for Allcargo global business as well.
Understood. So yes, that sounds really good. No incremental, substantial capex requirements. That's the takeaway from this conversation. Mr. Thakur, thank you so much for your time today, and thank you for throwing a light on what's happening within the company as well as the overall sector, given that there is so much turmoil on the geopolitical front. Once again, thanks so much for your time.
Thanks, it's my pleasure.
Thank you so much.